Oil very much in focus this morning after the CME Group said it would raise margin requirements to trade WTI, Brent, heating oil, also RBOB gasoline futures. WTI margins go up 25% after the close of business Tuesday U.S. time. Quick price check. NYMEX right now trading 101.26. Under pressure, as is Brent at 114.95. Let's get to Mickey Phelps, geologist, also mining analyst at Mercenary Geologist. He joins us live out of New York. Mickey, good to see you again. This CME move, did it catch you by surprise or not?
No, it doesn't really not. The entire commodities markets are a bit overheated and overbought right now. So we had, I thought, a much needed correction last week. We saw a rebound yesterday, or overnight that is, and so it didn't really catch me by surprise. I feel much more comfortable with oil. Let's be North American centric, since I'm located in North America, with West Texas crude trading around $100 versus the 115 it was at last week. So, we're looking at a 15% correction, and corrections are always healthy for overheated markets.
Mickey, but can't you argue that this is the regulators closing the proverbial barn door after the horse has bolted? I mean, why didn't they do this back at 2008 when oil prices were knocking on the door of $150 a barrel? And arguably, as one of our viewers has pointed out, why didn't they do it in tandem with the quantitative easing program at the Fed to help reduce the amount of cheap money out there?
Well, hindsight's always 20/20, and maybe perhaps they've learned their lesson this time. We do not want to see oil at $150 a barrel. It wreaks havoc with inflation throughout the world. So whether it came too late or it's exactly timing, that can be argued, but I'm very happy that it's happened at this stage.
All right. Listen, Mickey, we're getting an email in from a gentleman named Aaron Smith. And while we're trying to cobble it onto a graphic, let me just read it to you. It says, speculators are short and long. Raising margins just shakes out the small single contract players, i.e. People like Aaron, and causes bigger multi-contract players to add funds to their accounts or reduce their positions. Net, raising margins also kills trading volume, which kills exchange revenues. Margins are a risk management tool for the exchanges. The way to reduce the number of specs versus hedgers in the market is to position limits for speculators. What do you make of this, Mickey?
Well, I will certainly agree with Aaron's take there that position limits are perhaps needed in these very speculative markets. But the commodities markets are, in my opinion, by far the most speculative markets out there. So, in much a long-term fashion, the commodities markets have basically functioned on speculation, and in my opinion, that should not end.
Yeah, Mickey, if the markets are being juiced by the speculators, as many say that they are, then how big would you estimate that speculative premium to be? And conversely, what is the fair price then for crude oil?
Well, to tell you the truth right now, I'm comfortable with $100 oil. I think that the world can function quite well at $100 oil. If it starts getting into that frothy range of 115, or if for Brent 130, and then it can just build on itself, and that leads to rampant inflation. Then you'll get countries that very much fear inflation, especially food inflation, like China starting to cut back an overheated economy. So the range right here, $90 to $100, I think in current world conditions we can function quite well within that range.
Mickey, you're a geologist, so I really want to put this question to you. A lot of the bulls in gold and in oil constantly talk about peak supply in both of those commodities. Is that a fair assessment, and how real a situation is it on the ground?
Well, I'm not a subscriber to the theory of either peak oil or peak gold. Certainly, large oil fields reach their peak. We saw the peak in the United States in the 1970s, and but we've seen increased oil production over the last few years in the United States. I'm a firm believer in technology and the ability of engineers and scientists to go after harder to find oil, for instance. 70% of the oil ever discovered still remains in the ground. So with horizontal drilling and hydrofracking and new technology, deep water drilling, we can recover more and more of that oil. In the gold sector, we saw a peak in gold production a few years back, but that was a function of the gold price. For years, we did not have exploration. Now we're starting to see exploration and development and new mines come on, and we're exceeding gold production for the last 2 years. So it's gone up. So a firm believer in science and technology and the ability of geologists and engineers to provide us with what we need.
Okay, Mickey, real quickly, you're looking for gold to correct by about 5%, is that right? Another 5%?
Well, it has corrected about 5%, or it had as of yesterday. I would still look for a correction coming in gold. I think that's healthy. Gold has gone up very quickly, and markets tend to swing one way or the other too fast. So a healthy another 5 to 10% correction is expected by me, and I think would be very welcome at this stage to establish a new base. I remain a long-term secular bull in all commodities markets.
All right, the super cycle lives on. Mickey, great to talk to you. Thanks for the time. Mickey Fulp, mercenary geologist, live from across in New York.